Stocks this morning, meanwhile, are higher. Futures extending yesterday's gains as we await the November Producer Price Index. It's out at 8:30 a.m. Eastern. The Dow Industrials right now up 73. The S&P up 13 and the NASDAQ higher by 47. We're also looking ahead to the final Federal Reserve meeting of the year beginning Tuesday, December 13th. And the 14th, the central bank expected to raise rates by 50 basis points. Joining me right now is Federated Hermes, a chief equity market strategist, Phil Orlando. Phil, it's great to see you. Thanks so much for being here this morning. What do you make of this year-end rally, and do you think it has legs going into 2023?
So stock market was down about 27.5% into the middle of October, and we got a normal seasonal midterm election rally that tends to be up about 15 or 20% starting about a month before the midterms. We're up 17.5% over that from the mid-October period into last Friday. So we've largely played out this 15 to 20% rally, and I think there will be a shift back to understanding underlying fundamentals again, like inflation, and what is the Federal Reserve's monetary policy response to it going to be.
So what does that mean for 2023, Phil? Do you want to buy into this rally here, or do you see economic headwinds ahead that perhaps creates negative trading and declines for the new year as well?
Yeah, we're very cautious, Maria. We could very easily see the market retrace back to those mid-October lows, which was down around 3,500. We talked about the fact that inflation, you've got the PPI number today, CPI next week, and the inflation trends, we think inflation has peaked, but the decline back to the Fed's 2% target is going to be much more gradual than the market, I believe, perceives, and therefore the Fed is probably going to stay more vigilant than the market perceives. So given that combination and the fact that economic growth is coming down, we believe, in a glide path in a recession. Corporate earnings estimates, we believe, for next year are too high. We've already cut our S&P 500 number to $200 next year. We're at $220 for this year. Consensus earnings for next year are up around $235, Maria. If we're right directionally, then earnings estimates are going to have to start coming down, probably when the fourth quarter earnings are reported in a month, and management begins to provide guidance for next year. And I don't think a $200 earnings estimate for the S&P is in the market right now. So our best guess is that we've probably got a retracement back to those mid-October lows looking out over the next couple of months.
A very good point on earnings, because the estimates right now have not moved as much as the expectations have in terms of a slowing economy. One of our guests yesterday said, away from energy, there is no earnings growth. It's basically a flat situation. So looking at sectors then, Phil, do you want to still be buying energy? It had a great year, or I'm talking oil companies, or are there other sectors to hide in while this dislocation happens in early 23 that you're looking at?
Well, you hit the right word, Maria, which is hiding out. If we're right that the market's going to retrace from 4,100 to 3,500 over the next couple of months, then you want to continue to play defense. And what we're doing is continuing to overweight value versus growth and looking at the stable demand categories with low PEs, low betas, and high dividend yields. So energy stocks are at the very top of that list, along with healthcare, utilities, and consumer staples. From an energy perspective, energy prices have come down from $135 to about $70 or $75 over the last 6 months. Our best guess is, given that the dislocation that's going on right now in Russia, OPEC cutting 2 million barrels a day of production, and our own mismanagement of energy policy here, we could very easily see WTI, West Texas Intermediate crude oil prices, move back into that $120 neighborhood looking out over the next 6 months. So I think energy prices are probably attractive here. Energy stocks, we think, will probably continue to perform well looking out over the next couple of quarters.
Yeah, and they've got dividends as well. A number of them also said they're taking CapEx higher and will continue buybacks as well, stock buybacks. I'm with Adam Johnson this morning. Adam, jump in.
Oh, thanks, Maria. Phil, I appreciate the viewpoint, but I want to push back a little bit. Help me understand how, if you have the most number of people working ever, making the highest gross adjusted income ever, and spending the most amount of money ever, you can be so negative on earnings.
Well, you've got a dislocation in the marketplace that I think is manifesting itself, for example, in Christmas right now. The top half of America is doing fine. The bottom half of America, not so much. You've got personal savings rate, which has fallen from 26% March a year ago. We're down to 2.3% right now. That's a 17-year low. Excess savings have come down significantly from 2.3 trillion to 1.7 trillion over the last year or so. The bottom half of America down to about $350 billion in excess savings. Credit card usage has soared by 18% over the course of the last year, and credit card delinquencies have surged over the course of this year as well. So the bottom half of the consumer is struggling right now. So you look at Christmas spending overall, for example, up 16% year on year last year. We think that number might be half that this year, sort of a mid-single digit. So we're not canceling Christmas, but things are going to be a little slower than they were a year ago.
Yeah, I believe it was Jamie Dimon last week who said something around the lines of he sees $1.5 trillion right now in savings that consumers will likely get through, tap into throughout 2023. So they are looking at, tapping into savings accounts to pay for this 40-year high inflation. Phil, it's great to get your insights. As always, we so appreciate it. Have a great weekend.
Thank you very much for having me on.